Welcome to the Mind Money Spectrum podcast, where your hosts, Aaron Ogti and Trishul Patel, go beyond traditional finance questions to help you explore how to use your money to achieve the freedom you want in life.
Hi, I'm Aaron Ogti. I'm a financial advisor in the Bay Area. I'm here with Trishul Patel, a wealth manager on the East Coast.
Hey, Aaron, great to be here today. And thanks, everybody, for listening and watching.
Great to be here as well. So I'd like to think that over our conversations over the years, you and I have done an okay job of examining examining you should do this. Things like you should go to college. I feel like that has come up a decent amount. And today I want to examine that should, because I've had a client case come up where I find myself questioning that should, and like I'm not sure I'm going down a healthy path. Like it's definitely not going down the prudent path, but I'm pretty sure I'm providing good advice for this situation. And I really want to examine not just the technical side, but really how to help clients with emotions and feelings. Okay.
Okay.
So that's like kind of the premise of questioning the like default financial advice of here's what you should do. Okay.
Yeah, Aaron, I'm cracking up here because you said the one example you put up is you should go to college, but I think we pushed back enough on that.
Correct. So
Okay.
that's I used that very specifically. Like
Okay.
I'm priming you to question conventional wisdom.
Okay.
Okay.
Here we go.
One of my clients, they have probably an IPO coming up. Okay. They've been with me for a few years. We've had some private company stock planning issues, and we're guessing the IPO happens this year. Okay. So we don't know for certain. And because they've been with her for a few years, we've put a lot of the normal financial planning stuff in place first. So there happened to be a tender, so we were able to cash out a few years ago. We have a decent amount in a taxable investment account. We're saving for kids' college. They already own a home. They are saving really well from just the salary part of the job. They have managed expenses well. They are on track to be financially independent. In this, again, hypothetical, because I'm stretching things to make the conversation a little easier. Let's say they're on track to be financially independent in 10 years-ish, 10, 12, 15. Like there's a lot of leeway, but that's the track that they're on based on income, savings, expenses. Their kids are pretty young, so their kids won't be out of the house until 16 years plus. So like there'll still be kids in high school within that time frame. With the amount that's in the IPO, if it goes public at the 409A value last year, again, like a year ago, 2022, when we go into 2023, like a lot of tech companies were down. So it might be a few $100,000 after taxes. It's not enough to make them financially independent now. So if there's an IPO at this level, their lifestyle doesn't change at all. So they are going to keep saving for kids' college, going to keep saving for financial independence, still on track to be financial independent in, again, 10, 12 years-ish. And maybe if they cashed out and like with the growth of that IPO, if they sold everything, they might be accelerate that financial independence from, let's say, 10 to 12 years to like 5 to 8 years, something like that. It would definitely accelerate. It would definitely help, but doesn't change their lifestyle now. Won't change their lifestyle for the next few years. It's still going to be working, saving, taking care of kids, living the lifestyle that they enjoy, that they're very happy. And like this is part of the planning of we've gotten to this place. And so this is not life-changing money from that perspective.
Mm-hmm.
Okay.
And just to be clear, you said a few $100K after tax from the
for this example, we'll say that. Yeah. Let's say
Okay.
it's somewhere in the 300 to 600K.
Sure.
Not enough for them to retire off of. Makes them more comfortable, but it's like not enough to like double the size of their house, which they don't really want because they're
Mhm.
very happy with so far. They're at this point, there's no particular wants in their life, and the only kind of thing with like if they were financially independent, maybe he would stop working sooner rather than later and explore something else. Like
Mhm.
he's an engineer and wants to tinker, wants to build some kind of project. Like he's always going to be coding or building something. That's just kind of the way a lot of the engineer clients that I have are wired. And so he's very comfortable with his job, but he'll probably keep doing some work in some capacity. Does have kids, maybe spends more time with them, something like that. But the idea is that if the IPO happened at this level, then he's still working for at least 5 to 8 years.
Mhm.
But if they hold on to the stock and it, let's say, triples, which is not unheard of in an IPO situation. It's not the norm, not a plan. But if it triples, then they actually could be close to financially independent. Where if it was like 500,000, now it's like 1.2, 1.5 million, and they could be financially independent. But a diversified portfolio isn't going to triple in 5 to 8 years. Like, it's possible, but it's nowhere close to a realistic expectation.
And just to be clear, you're talking about this tripling happening post IPO,
Yeah,
or
yeah.
right around the
Well,
IPO?
or it'd be like, because we don't know like what the IPO number is yet. That's part of the conversation that we still need to have. Of we know what the 409A value was last year,
Yeah.
and that's not enough. So like, if the IPO number could be triple that, that's a possibility, but we
Yeah.
don't think so. But we want to try and plan expectations in advance, not like because the easy math was, let's say the 409A was like $20, and it's like, okay, if the IPO is 80, cash out, sell everything, you're financially independent, we're good. If the IPO is 40, like, okay, probably allowing to sell some, like decent, some kind of some amount, but it's that kind of feeling like, what if the IPO is 20? Like that's already like more money than they were planning on.
Mhm.
And what if it's somewhere between that 20 and 80 range? Where again, this is
Mhm.
not necessarily money they need. It doesn't change their lifestyle. And so I'm not as concerned about the mechanics and the taxes, and they really do understand the risks. I'm really trying to think about the emotions and feelings of this, like this extra money. And it could apply to clients at public traded companies that have RSUs, where they're not dependent on RSU income for their lifestyle. So they could sell and diversify, or they could hold on to the company stock just for that unknown upside. But those established publicly traded companies, while they might outperform the market, seeing that kind of growth is less likely than you would see with an IPO. At least, but also I have seen clients with go through IPOs like, and it goes down like 90%. Like that's also a realistic possibility. But again, they're still saving well. They're happy now. They're on track to be financially independent in 10, 12 years. So if it goes down, they've still achieved all the financial goals that they want to. At least they're on track to do so just based on salary. And so it's more that dealing with at again, the emotions and feelings of, if they take this bet and it fails, how do they feel? And if they sell and diversify and it does triple, how do they feel? And like all like everywhere else in between.
Mm-hmm.
So I think that's what I'm trying to get to. Like, all the kind of conventional was like, they should sell their risky single company stock concentrated position, but it doesn't change their lifestyle if they do. And so I think that's what I'm trying to get. Like, that's the should that I'm looking at, and I'm trying to talk this question. I have a couple ideas I want to get to, and some framework. But when you think of that, like, if I've laid this out well,
Mm-hmm.
when you think about like the emotions and feelings both ways, whether they hold or sell, for like, what are your like? Do you have any questions on the premise, or like, do you want to get into your history, or like, is it just like, nope, they should cash out, like, too risky?
Right.
This is where the should is right.
Yeah. Right. So, yeah, we could certainly pull in my own personal history, and I have dealt with an IPO situation with one of my previous employers. But before I get to that, I was thinking maybe we should outline what the rational what do they call it? Homo
Economicus.
Yeah. What would the Homo economicus employee do in this type of situation? So you're pulling all of that back. I feel like the strategy there would probably be something around, okay, you have your long-term investment strategy to reach financial independence, whatever that happens to be.
Yeah.
And you have this windfall that's come in. So likely what you would do is, assuming taxes were handled, like you said, somehow the tax situation was optimized, you would probably diversify away from the stock, or come up with some percentage of your overall portfolio to be in speculative investments. And this would make up a good part of that pie. Let's say 10% of your overall net worth ends up being in speculation. If you're currently at $2 million net worth, then 200,000 of this stock would stay in there if you have no other speculative investments. So out of 600,000 IPO, a third of it would keep, 2/3 you'd sell, put the 2/3 in a diversified portfolio that's aligned with your long-term strategy. And that's probably what I would say. I would probably do for myself, frankly, with my non-emotional hat on, right? My
Okay.
full.
I'd say the other similar strategy that I have used with other clients is, what's the amount that you need for your lifestyle? So if this number means that you're financially independent, how much do we sell, pay the taxes? You now have this diversified portfolio, you're financially independent. Anything on top of that, it kind of doesn't matter if it's diversified or concentrated. Like, you could lose that all, and your lifestyle is like, again, you're financially independent. You've taken care of all the goals, the college education, like pay off the mortgage, you're like, whether like you pay off the mortgage or keep it invested, that's a separate conversation. But you are financially independent. You've achieved all the goals. That excess could be invested in that company stock, could also be invested in any other single company stock or any other risky position. But it's no longer the company stock you're no longer dependent on for your lifestyle, which is, it's okay to hold on to that, even if it does make a larger percentage of your net worth. I'd say that's similar. And
Yeah, the caveat. Well, I'd say that the caveat to that is, like, the premise of this example is they're 10 to 12 years out from financial independence. So
correct.
Yeah, if they were closer or even over that bridge, then yeah, I'd say sure, you can take on more speculation if you like. I would still, in that case, try to say probably not more than 20%, even though you could, That doesn't mean you should, but that's all. That comes down to personal opinion at that point, because like you said, you could lose all of that and still be okay. So it won't make a difference if you do to your own life if you are already financially independent without that set of funds.
Yeah. So, yeah, I agree. The concentration risk is like deciding on that number, how much you want to put in speculation. Like that's a good framework. And I guess part of it in this example, because I think the age matters, where especially with kids, because they're still in the house and in school. So this is a younger couple. They're not going to retire and like travel the world or whatever their hobbies are. They're still kind of beholden to the kids' school schedule. Now again, like it could get to like your example, like, oh, that's why you do homeschooling and you can teach them as they travel the world. Like that's a different like fire pursuit kind of thing. But let's say for this conversation, they're going to keep going to the local school because that's where the social environment is, and so they're going to keep working likely for the next 16 plus years anyways, doing something, whether it's kind of paid employment or some other project that could pay off, but like they're no longer dependent on the work for their income.
Yeah. I think something else might play in here, because for what I also heard is, like you said, with the engineer in this situation, I think it was the husband, but he was comfortable working, right, even past financial independence at some level. In my mind, what might be even on the table is some of those threads that we unraveled in that Kinder conversation about ideal day, week, year, where with an understanding of how that might play out for this situation with these two individuals, maybe there's a transition that they could make in their own personal lives that they can start doing sooner rather than later with the understanding of this windfall. For example, if they're thinking of doing part-time after financial independence, right, or some sort of work at a de minimis level, why not put that into the plan and say, hey, if you start part-time, you could be financially independent if you can make up half of your income needs in the next 4 years instead of the next, like 10 years. And then you add in a good IPO and you could probably do that next year. How does that sound? And part of it might be, I like the full-time job and I like the amount of workload and I like the balance, but part of it might also be there could be an opportunity here for making other lifestyle choices that might be insightful to uncover.
Okay, so I like that framing because that's looking for other opportunities. How can we take advantage of this windfall in a way that it helps your lifestyle? That was not something that we were considering before we had the windfall. Like we had income, cash flow, and we are on track, but now we're looking for a new way to take advantage of that opportunity. I'm going to come back to like I now have multiple clients who have gone through an IPO. They are financially independent, and they're still doing like the exact same work 2 years later that they were doing 2 years before the IPO. Like they just like the work. Like they're very happy with their lifestyle. They travel well. They have kids in the house. They go to school. And so I have seen enough of these examples where their diversified portfolio just keeps growing and they're not using it.
Yeah.
And it's one of those things like, and these particular examples, like if they had held on to the company stock, it would not have gone up that much to make enough of a difference. And again, we did cash out. So actually, I think that's part of the key. We did cash out at that point and held on to some. And so I think that's like that's a different feeling than we sold some to take care of all the needs, goals, wants, whatever that phrasing is, and then we held on to the rest. This particular case, they've already done the needs, goals, wants side. And so like it would almost be easier for them from an emotional perspective. We're going to sell enough to fully fund 529 plans so we don't have to worry about college. And then we'll hold on to the rest. Because they know what I think that's what it is. They know what they're selling for. That's an easier emotional conversation than the Homo economicus of like, we're selling this just for diversification, just pure diversification. That's the only reason we're selling the stock.
Well, it's not only that, because it's the notion that you are financially independent, right? Meaning you've sold enough such that you no longer need any more to sell anymore to meet all of your life goals in this new situation, right? And you're already financially independent. It goes back to our earlier premise. Now, in theory, what we're saying is you can lose all of this and it won't change your lifestyle one iota, right? But there is some notion, some question, or some conversation that should be had on how much risk do you really want to take with your overall portfolio? Do you really want to keep building up this idiosyncratic risk indefinitely? Or do you want to come up with a strategy where it represents X% of your overall pie and try to stay within those guardrails on a go-forward basis? So it's diversifying to that level because that's what you've decided is a sensible breakdown for your situation.
Okay, so that's fair. And so maybe it's not you should diversify as that. Like that might be not the right phrasing, but more every individual client case has something, and I, as their advisor, need to do a better job of kind of helping them dig to find what that something is. Because we have to, like, if it gets to 80, they have no problem selling, cashing out, they're financially independent. Like, they're actually comfortable with that. And if they kind of want to hold on to this and see if it can get to 80. And if it doesn't, they have said they're okay with that. And I've made sure that we've taken care of all the other stuff that they like their work. Like we've had a lot of these qualitative life planning conversations. And so from that perspective, I do trust that they know themselves well enough, I guess I'd say.
Yeah.
But there's probably something like that we sell at 80 for each individual client case of what's enough to make you feel the difference, or like.
Yeah. And again, I would say it's not a function of the stock. I'd say it's a function of this position relative to the size of the overall portfolio, the overall net worth, and coming up with some understanding of comfort. And I'd say that's true even if you're financially independent.
I would say let's for between taxable investments and retirement accounts. That's like a small thing. It's like based on their age, we need enough in the taxable accounts because the retirement accounts are still far enough away that like they're young. They're in their, let's say, close to 40. They're like late 30s, early 40s. So, but between those two, let's say they have $1 million, and if this IPO happens, it'll be like going from 1 million to 1.5 if they had cashed out. So the company stock is again like a third, 30 to 40%.
Yeah.
Yeah, and like I'd say they are telling me they're comfortable if it's 50% or more, because if the company stock is worth $1 million and their outside assets are worth $1 million, then they're still not quite financially independent, but they are like 4 years. It's like 4 to 5 years, 3 to 5 years, depending of savings worth of paying away.
Yeah.
So
I really think it's a tough emotional decision. Grant, it is, right? Because you're working for this company, you've seen the stock price do well, and it's IPOing for a reason, right? It's not IPOing because there's been poor performance. It's been a good ride up until now, and you know the company and you feel comfortable with it. But even so, I feel like there's still that conversation of, okay, great, that's all nice and true, but realistically, how, in the first scenario, how much of your net worth are you comfortable speculating on in general, irrespective of this company? And then, think about the fact that, okay, if you are going to speculate and it is going to be for this company, realize it's already your employer, it's already tied to your paycheck, meaning you already have one degree of risk there.
yeah.
If they both work for the same employer, okay, well, double that, right? And now your income stream, your if you're getting more shares over time is also tied to it. And then in addition, you have this other leg also tied to the same employer's performance. That's a lot of risk.
So again, that feels very Homo economicus. It's like,
it is. And the other thing to realize is there's zero reason to believe that this stock should do better than the broad market.
I acknowledge that. It's what we're doing is a diversified portfolio has a likely range of outcomes, and a single company stock has a much wider range of outcomes.
Yeah.
It's and I think that's what it's like. I guess they have said that they would like to try and see if they could for swing for the fences in just kind of see if this could really be life-changing money, because they want to see could they get their net worth to 5 million, 6 million, that might allow them to travel a little bit nicer, especially with kids. It makes a lot of those things a little easier. Maybe do some additions to the house that they have not really planned on. It's not really a desire, but it might be nice. So that they have some ideas of what that could be. And I think I need to get them to be more specific.
Yeah, have you had some sort of conversation around what percent, irrespective of this company, they might be comfortable putting in speculative investments?
No, because because that's what I tend not to like that. I look at it and we've discussed it, but 10%, 20%, 30%, that concentration percentage. I feel like it doesn't necessarily help decision-making process for some clients that has worked. For some, we may be here's your diversified portfolio, here's your retirement account, here's your company stock. If your company stock goes up, we sell it, move it over here. If it goes down, the diversified portfolio is up, we can hold on to it. That we've had that. That's helped with mechanics and framing for some other clients. So I have had that a little bit, but. And I've done for many clients, we're selling this stock, we're going to put this much into your 529 plans. This much is going to help you get a down payment on next house. We've had specific goal oriented. And you know what? I think that's what it is. I tend to find that conversations in dollars are more helpful and more impactful than conversations in terms of percentages. I think that's probably if I had to succinctly explain why I don't get into the risk difference between a 10% and 20% concentration.
Sure. Yeah. You can definitely layer it in with dollars and cents. But I think the premise in my mind is okay, so you have Homo economicus who would say, frankly, 100% goes in the base strategy and 0 for speculation, right? And based upon that, the amount that you add into speculation, the theory is that if you do the speculation part well, you might have a slightly higher return, but probably a higher risk to go with it. So your risk adjusted return is actually slightly lower. But again,
I agree with that premise. The risk adjusted return is lower. I agree with
that. So you're giving that up a bit. And what you're gaining is the potential for extra return. However, that's in optimal sense, meaning that speculative slice should be managed quite optimally. And there's many reasons why that may not happen. For example, you can get into a situation where that slice starts to grow, and over time it becomes a big chunk. And now you have this constant decision of, okay, what are you going to get out or not? Is the company doing well or not? And what if you one day just have to liquidate a huge position? You're going to put yourself in a pretty big tax situation at what may not be the most ideal time. So there might be roadblocks with this strategy, which lend to you end up being guaranteed to not be in, a better return angle or a better risk adjusted return angle, because you have this window of concern to deal with. Also, if you get it to the point where that position starts to grow quite big, and now you're in a financially independent state, you have a pretty big problem to deal with, right? You got a couple million in one position, which might be 2/3 of your net worth now, even though it started at 20% and you never pared it down. And now it's a lot of risk, but also it's a lot of there's going to be a lot of headache to get that into a position where you're diversified again. You may have to trim that back year over year for like 5-6 years, and constantly manage the tax situation and hope the company cooperates, and performs sensibly over that time frame. So it may not make your life that much easier, and you may not get the benefits as well. And this might be the median case, frankly.
Yeah. I would say part of it is like I think I've done a pretty good job. Like we've been exercising ISOs, staying under AMT each year. So there's a decent amount where it's going to be long-term capital gains regardless. His salary's high enough that it's going to probably be like, regardless of which chunk we sell, it's going to be 20 to like 23.4%. Federally, like probably regardless of which year we sell. So I'm not necessarily worried about trying to time the taxes. It would, and I do think like if it got to a number, they would have no problems. I think a harder part actually might be like trading windows, where it gets to a number and they have to wait 2 months to sell because he still works at the company. That might be an example of like the less optimal managing that risky position. And I can see for most of the people, most of my other clients, like because they also have RSU grants, that vest over the next few years, like they still get some of that feeling of that upside. And I think he could get into that phase. Like, I don't know if the company's like planning on that. And I feel like all of these still don't help the client answer that question of like, they'd like to take on some risk. They say that they understand the risks. And if they sold in triple and it does triple, I think they would feel a little upset. I think they would feel worse than if they held and it went down 90%. I genuinely think that's the case for this particular client.
Yeah, it is a tough one.
Am I trying to justify their feelings, kind of thing?
It's tough because if you're essentially, it's a similar mindset of somebody who's been stock picking, frankly. In this case, it's kind of like forced stock picking because you're doing these things without even wanting to. But the emotional attachment is similar, right?
They bought Netflix 10 years ago. They had Nvidia. They had some of these big stocks. Like, look at all that unrealized gain I have. I know what you mean. It's
right. And what I've seen, for example, in this similar situation is I've seen a handful of times where a client has surely enough to be financially independent, but a big reason why they got there as quick as they did was a handful of speculative investments, right? Like they got into Microsoft or Apple or, any of the FANGs, right? 10, 20 years ago. And it's tough to transition away from that because it helped you so much over the last 10, 20 years. It got you to where you are. And the conversation that I try to have is just because something got you here doesn't mean you have to stick with it to stay here, right? Just because stock picking worked to get you to financial independence doesn't mean you have to stay with this now that you're already here. It's the notion of, do you really want to snatch defeat from the jaws of victory, right? You've already won the race.
Meg Bartelt has written about this. I've had enough conversations with her. Concentration helps you build wealth. Diversification helps you protect wealth.
Yeah.
And that, again, I feel much more comfortable with that perspective. Like, and that's why even the clients, like, if it got to 80, they have no problem selling, kind of thing. And it's possible it could IPO that. Like, and like, it's that, like, if it IPOs at 40, do they just wait to see if it gets to 80, or wait until like 5, 3, like each year it goes along the way? We like figure out, well, we're going to sell this, like, or because their savings and their taxable investments have grown enough that, like, once they build up that, because that's something like, because I have seen this play out a little bit, because they're saving so well into retirement accounts and what the taxable investments have built up. If the stock stayed flat, their other investments actually be going up, just based on the savings that they're putting in there, and so their concentration risk actually would be going down over time. And so they're trying to see, can this get to it's like actually being a number for them?
Yeah,
and because they would have. And if I push them hard enough, and so one of the ideas I had, like I've seen this others, like, I definitely think they should sell some. And whether it's like splurge on something like a vacation, like sell 20K's worth and spend 10K on something. Doesn't matter what it is. Like sell some. And I think they might create enough positive feelings for them. And also I wonder if that would get them into the habit or comfort level of selling more.
Yeah.
But I can tell when we've had these conversations, selling just for the purpose of diversification, especially because, So again, I think it's like because this particular client had a tender offer, so they already sold a chunk pre-IPO to help build this. Like, was that the amount that gave them this opportunity to be more aggressive with the remainder?
Mm-hmm.
And I've seen it kind of with another example, like clients have a mildly successful exit at one company. They have some, again, they're not financially independent enough. They have enough in a taxable investment. They move to a new company that, again, is they have again a few $100,000 in taxable investments. They've been saving the retirement accounts really well, and then they have this new company, again, same thing, like selling all at the IPO price doesn't make them financially independent, doesn't change their lifestyle at all. They still go to work, they still spend money on vacations, their day-to-day doesn't change. And it's like, oh, you should sell to diversify, to accelerate financial independence a few years. Like that I guess hard to convince them of the tangible benefits. I guess what they can't conceive any tangible benefit. I guess what that's why I look at they can't like internalize any tangible benefit to selling.
Yeah. Here's one thing you might consider. Let's say it IPOs at $500,000, right?
Mm-hmm.
A good question to think about with any investment decision is, let's say they come to you and they say, I have $1.5 million net worth. And you tell them, okay, are you going to spend $500,000 buying this stock today at its current price?
I agree. That's a great framing. Does that ever work?
Well, I think it opens up a window of question, because sometimes the answer will be quick. There's two answers you'll get. You'll get the initial reaction, right? And that might be the true answer you're kind of looking for. And then you'll get the substantiation of what the emotions say, right? So, for example, I've asked this before, and sometimes I got to meet. No, I wouldn't do that. But wait, what are we talking about then? You wouldn't feel comfortable buying this stock that you're thinking of holding, right? Like, you wouldn't go out of your way to buy it, really? And it opens up the question of, wait, if you wouldn't buy it, why are you holding it? And
see, I feel like because they've been they've been exercising options.
Yeah,
they have been putting money into this stock, and they do like it, and they do feel comfortable, and maybe not to that scale, but I do think that's like, because I have other clients that they go work at a pre-IPO company, and we start to like, yes, there are potential tax benefits to exercising earlier, and I can help you manage the AMT, but like any money you put in this, you have to be willing to lose completely. And that's probably, like, I wonder if that's part of the phrase. Like, they already know all the money they've put into exercising these options, they're already willing to lose completely.
Yeah. Well, the two things, the tangible benefit could be, okay, are you comfortable losing this and having to work 3 years more, right?
Yes.
Reach financial independence 3 years later. Is that a good trade-off for you? Or would you rather have try to lock in that extra 3 years of not having to work and, diversify? And that's 3 years of getting up, shoveling the snow, going in traffic, commuting. If you don't mind that,
we're in the Bay Area and they're working from home. Like I understand what you're saying, but
whatever that entails, right? But again, it is a tricky scenario, because the client very likely will not be looking for major lifestyle changes either way, which is fine. But
yes. As I try to like frame possibilities, it's like, those things don't matter. But like, if he could add a room to his house for his home office, like that might be worth it. Like, and like that's one of the things. Like, that's why he wants to hold on to the stock. And so, like, I guess I phrased it like, but if we could do that, and I've tried to push down. Like I'm trying to like use the this is an example of like other clients. Like there's too much of like, it's just this particular client. Like it's a single case.
Yeah.
Because I also like, oh, let's sell the stock of the IPO, build the home office. You work the extra 3 to 5 years that you're going to work anyways. We hadn't sold the company stock, but your lifestyle is nicer along the way.
Right. Here's back to that question though. Again, they have one. You tell them you have 1.5 million. How much of this stock are you going to buy? I know you bought the options. I know you bought over time. I know you've held a good amount. But realistically, if you had 1.5 million in your pocket, how much are you going to put into this one company? And why this one company versus every other company on the planet, right? Why 500,000 here and 0.0000000 everywhere else?
It's again, it's a time motion. It's the IPOs and the small caps are just, they have a chance. They have that wider dispersion of possibilities. They kind of want to gamble with it.
Yeah, but why not a small cap ETF, right?
Like dispersions are too low, but I understand.
Yeah, or why not take a list of small caps and throw a dart? You'll have the same probability of success with less risk because it's not tied to your employer, your paycheck.
Yeah, that's right. So again,
I wouldn't say any of this to any client, this bluntly, to be honest. So I know why you're pausing. Obviously this isn't how, candid conversations work. It's more about understanding where a client is coming from and putting best thinking forward, but realizing at the end of this day, a client is in the driver's seat for these types of decisions. And, the best we can do is put our best thinking forward and let them make the final decision.
I think that's I think that's part of like I think part of the reason I want to ask today is like, how do you emotionally prepare for these types of decisions? Like you have to pick a number.
Mm-hmm.
Is it, and like I have found actually like arbitrary round numbers tend to work amazingly well. We're going to sell 25% regardless.
Yeah.
We're going to sell, if the stock goes up like 10%, we're going to sell another 25%. If stock goes up, so like, and you just pick like these scales, and like we're going to hold on to 25% regardless. And like these arbitrary numbers, I'm shocked like how well they work. And it's like, it's almost like when you say 10% in a concentrated position as like a concentration risk, why not 20%? And like, why not 18? Why not 12? Like those arbitrary round numbers work surprisingly well.
So what I've said in the past in those conversations is, typically the spiel goes something like this. Typically, it's not really necessary to speculate with any of your investments. We can reach all of your goals without that. But if you want to, you're certainly welcome to. What I recommend is try to keep speculation to between 10 to 20% of your net worth. And if you feel like being more aggressive, go for the 10. If you want to dabble, but still be more on the conservative side, 10. If you want to split the difference, 15, right? A, B, C. And again, it haven't got too much pushback on something like that, except in the case where, as I mentioned, there's been situations where people have reached financial independence, they've already won the race, but now all of a sudden, more than half of their portfolio is concentrated.
See, I guess I haven't had that scenario. Like for me, it's all, and I feel fairly comfortable like pushing pretty hard. It's like, no, financial independence money, we cannot depend on single company stock. That's why we cannot depend on single company stock kind of for anything.
Yeah.
So if this is financial independence, it's diversified. It's once we get above that, I tend to be pretty lax with like what they really want to do with the money.
Sure. Yeah.
And some clients, they do like the feeling that they are still holders in the company stock, depending on scale, when they go into work. And I think there are intangible benefits to that. And again, but I've gotten to be very clear. Like if any single company stock, we're not depending on this. This is not. We're planning on using this money for anything in particular. That's almost like easy. Like as I say, the kids' college, fully funded 529 plan, paying off a mortgage, which like interest rates versus diversification, like that might be like we move that to a diversified portfolio. If they are closer to being financial independence, or like closer to retirement. That's what, as I say, like we've been talking about financial independence, but they're closer to retirement. Again, more likely like we need to sell sooner just based on age and time frame.
Yeah.
But this is like based on their age, based on their family lifestyle. Like if they didn't have this, they'd still be happy. And if they hold on to it, they hold on to it for like 10, 20 years. They have no problem with that.
Yeah.
But they want to see, like, could this be a Microsoft millionaire kind of story where I think that's what they think. Like if they see no downside to holding on to it, but there is some unlikely but possible upside.
Yeah.
I think that's probably the way that they're looking at it right now. Like we've done enough of the other stuff that it would be a paper loss that they don't have any kind of tangible way to associate with.
Yeah, I think it's a notion of if the trade-off is really they got to work a few years more in a job that they love, that it seems like it's not a big decision, right? It's not a big deal if they lose every cent of the stock.
Yeah, I'd say tangibly that's the case. That's like why the feelings are almost harder to manage at that point.
Well,
like if the IPO doubles, do they still hold on to it? And I've had some client cases where IPO was very successful and we like sold up, like it kept going up, kept selling more as it kept going up.
Yeah.
And that more or less worked out. And it actually allowed one of my clients to retire earlier than he expected to because he held on to it a little bit. Like it was an IPO at like 16, sold a big chunk at 40, and that allowed him to retire. Sold more in the hundreds, kind of kept going up, came back down, but it was the big chunk that he sold at 40 that allowed him to do that.
Right. Yeah. I guess also what I wanted to touch on a little bit is this reminds me of what somebody might consider if they're gonna get a windfall, from like the lottery or inheritance, or, right? So I think the similar bullet points that you might consider in those situations likely, apply to something like this.
Yeah.
And
there's definitely that, like, moving from single company stock to diversified all stock portfolio is getting more conservative. For the lottery, it's sitting in cash. Moving to an all stock portfolio would be too aggressive, even though like the mechanics are kind of like the same either way.
Right. Like, yeah. So I was gonna highlight some differences and some overlap between that. I just Googled very quickly 7 things to do after receiving a windfall, and I'll share the screen.
Read and studied Sudden Money. There's a
if you got one, you can share one.
No, go ahead.
Okay, it's literally just whatever link popped up.
Okay.
I haven't really read it. Let's check this out in real time. But they're all similar, right? Basically, you get a windfall. You don't want to be too irrational. You want to come up with a methodology to handle it. So I'll just read off the headlines here. Big one is just kind of pause before you decide anything. No need to rush the judgment. Often what I've heard is, take like even a year or 6 months, before
that's
you
one of the
make
big things.
right,
Yeah.
any big decisions.
So
And then
that's part of the challenge. I'd say that's part of the challenge with like the difference between windfall cash and windfall stock is moving to diversified portfolio. Yes, like you want to wait a year before you spend anything. Don't buy a vacation house. Don't quit your job. Don't like all of that really helps from a lifestyle perspective. With the single stock, if you wait a year, like that's you've already made that decision, I guess. Like you've chosen to opt, or like you're choosing to hold on to the stock instead of cashing out. But like 1 year's worth of volatility in the stock is high.
It is. Again, putting tax aside, because there may very well be a tax-related reason why you're holding on to it longer than you want to. Assuming that's not an issue, again, the Homo economicus standpoint would be, well, you may want to think of it as if you actually did get a cash windfall, and do you want to keep it in the stock for a year, or do you want to, cash it out and diversify, right? That's your kind of base case. Yeah. So actually keeping it invested is more of a decision than doing nothing in this situation.
Yeah.
And that kind of dovetails into the second point: find a smart place to stash the money. So obviously, it's a big decision, right? You want to come up with a plan. That's obviously why your client is and you are muddling or stepping through this process. Obviously, talk to experts. That jumps right into what's happening in the situation. Consider the payout options, right? That's all part of the conversation. Tax implications, you mentioned. You've gone through that process, getting the state plan in check. This one will probably not have huge impact on the final estate, but there's situations where it could. And then you even mentioned the splurge a little notion, right? Spending the 10, 15K on the vacation or something like that.
Yeah.
That might help with that emotional component of wanting to do something, because you did have it's an important accomplishment, right? It should be rewarded accordingly as well.
Okay. I don't know if I get any conclusions from this, but
well, I have one that I wanted to share. I think in this particular situation, it's a good problem to have, right? It's not one of those where the client's going to be on the street or they're going to, right?
Correct.
So I think either way, the client will be okay, right? I think if they know the options and they're comfortable with the choice, it really is not going to make a big difference.
That's an interesting putting of it. Of the $500,000 decision is kind of like on the margins. Like, don't spend too much time or energy focusing on this. You'll be fine either way.
It's not going to be life-changing, right? It might be the difference of buying a supercar at retirement or a standard Lamborghini, right? Where you really notice that extra half a second on the quarter mile. I doubt it.
Based on their based on their lifestyle, like they're not even, they don't, that's like, they're not looking for that kind of extravagance. It would be building extra room on the house kind of thing.
Or, first class versus business class, right? You get extra napkins and a bigger bottle of wine on the international trips.
I have talked to one of my clients who has flown first class. He flew enough for work that he always had like upgrades. And he was mentioning like sleeping on international flights, I think, makes a difference.
Yeah.
I have never experienced it in my life. I don't know if I ever will. Maybe 20 years from now, maybe. So we'll see.
Right.
Have you ever flown first class?
No, just business overseas, which is good enough because you get the flat bed in most cases.
Okay.
And not out of my own paycheck. It's certainly covered by the... The closest to first would be like private jet a few times for the work.
So okay, so is being able to lie flat and sleep on an overseas flight worth it?
Yes. Yeah,
Okay.
that's the main thing you want, right? The ability to it could be nothing else besides that, and
Okay.
yeah, you'd probably be okay. Yeah.
So you're telling them to hold on to stocks if they can get there.
Well, like I said, you can do that with business, so you don't need first to get there. It was my larger point.
Well, if they're trying to do it for a family of 5. Okay. Okay. I think this is a. I hope that anyone listening to this conversation almost understands like how difficult these conversations are. Like sometimes there are clear cut like yes, sell all now. Sometimes it's like sell for this, hold on to this. Like, but sometimes it's like even there's no Homo economicus like that's doesn't adjust the feelings that you're gonna have. And you might feel bad either way, you might feel good either way. But there's a lot of these kind of gray area decisions that aren't easy.
Yeah, I agree. I mean, in terms of impact, these might be the biggest decisions you make, right, in your life. Like, where in your life do you make a decision where if you go left versus right, it can have,
Yeah.
hundreds of thousands of dollars worth of impact. I was even thinking, well, medical decisions are big, but then even kind of with that, you have the expert decisions, the best thinking, and often there's maybe less of a need to um, speculate, right? In terms
Yeah.
of outcomes.
Yeah.
Although I'm hedging on that as well, so I may put it on par because there's enough uncertainty there as well. But
So like
still,
when I think like my health decision, like having surgery, like I want to be able to play sports. Like having surgery was an easy decision. Again,
yeah,
like
yeah.
so
Yeah, I guess what was flashing through my mind is, but then there are, like later stage health decisions on do you go
yeah.
for the X treatment versus the Y treatment? And frankly, it's just as tough, if not harder. So
Yeah.
these are tough life decisions. There's probably not going to be an easy answer, but working through it, talking through it, I think is probably the best way to go.
Yeah, I agree. So did you find this like can you think of a situation where you would hold on to the stock now?
Well, okay, so I mentioned in the way beginning that I was in a similar situation with my own
Yeah.
personal life. The way that kind of funneled through is one of my previous employers, they were gonna have an ICO, which is an initial coin offering. It's an overseas company, and this was a big popular thing maybe 7, 8 years ago,
Yeah.
where you could go public by issuing coins in
Yeah.
cryptocurrency that tie back to the value of the stock, etc. The whole thing the whole market kind of blew up around that time, so it never happened. But
Probably a good thing.
leading up to
Yeah.
it, yeah, I was doing a lot of questioning and going through all of these emotional roller coaster steps. So I certainly realized not an easy decision at all, because it does make a big difference. Where I kind of landed on is at the time, the dividends coming in were enough to kind of cover my expenses. So I still made the decision to leave my career because of having this safety net. But in terms of my financial independence number, I actually discounted the shares quite heavily because they weren't public, and they still aren't public
Yeah.
currently. So it allowed me to have the bridge and the confidence to shift away from my 9 to 5 career and kind of take off from there into what I'm doing now. But it didn't give me the confidence to put my gas on the spending to the level that I probably could had the IPO gone through. And I probably still don't feel as comfortable doing so.
So this is another example I could that came to my mind, but I don't want to take too much time. Let's like I want to leave at this and see if he'll come back later.
Okay.
If you had a relative who had $200,000 in Microsoft stock that they left to you.
Yeah.
And so again, like step up in basis, you could sell it, no tax implications.
Yeah.
And again, you are working, you're like, that's providing your lifestyle, you're happy with your job. Like what would you do with that?
I know the answer, but I don't know. I would sell it immediately.
And do what?
And invest in a diversified portfolio.
And do what?
And not change anything in my lifestyle.
So maybe you're just a better Homo economicus than everyone else.
It wouldn't make a difference. I think the main driving force of my financial decision these days is simplicity. Right? What's the simplest thing to do to keep my life as simple as possible? And I see the Microsoft stock as a headache. It's a constant decision that I'll have to make every day. Do I want it? Would I buy it? Right? Do I keep it? And I just don't want to deal with it.
That's actually relevant. I think that is a relevant factor.
Yeah.
I think that for most other people, if they inherit it and like it wasn't part of lifestyle before and they forget it's there and they look up 10 years later and they're pleasantly surprised.
Yeah. Well, so from my standpoint, I've had a similar line of thinking of would I ever go back to work for any reason, right? Like, what if they paid me 10 times more than what I was making before? And no, like I like the simplicity.
See, I completely agree because I think that's almost different because like I get offers of like, hey, sell your firm, we'll buy your firm if you come work for us. I like that, and it's like I really don't want to. Like, that sounds so bad.
So
but I think it's like it's a different path kind of thing. But the simplicity idea I think that's a relevant factor.
Well, and it ties back because my life is simple now. I'm not looking for extra complexity in any way, shape, or form. In fact, if I can work out ways to make it even more simple, then I'd probably go for it.
Okay. Well, it's not like I want to find something that you would splurge on. That's a conversation for a different day.
I remember one year I got a bonus and my wife's like, what do you want to do? We went to Taco Bell. It was the largest bonus of my life.
Maybe you're not the right person to have this conversation with.
No.
Okay, I think we're gonna wrap up there. We'll find something else that's I gotta trigger you somehow. What triggers Trishul?
All right, that can be where we try to pick up for the next one.
Okay, this is a great talk, Trishul. Thank you.
Okay, well, good stuff, Aaron. I hope you guys enjoyed this one. We'd welcome your feedback. If you have any insight on what you want us to dig into or what you liked or didn't like about this conversation, let us know. Don't forget to like, share, and subscribe. And thanks for listening and watching. Bye.
Bye. We appreciate you joining us today for this episode of the Mind Money Spectrum podcast. Be sure to visit mindmoneyspectrum.com to access the entire library of episodes. Remember, it's not black and white, but the wide spectrum of gray area where you get to pursue the freedoms you want in life. Opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performance referenced is historical as no guarantee of future results. All indices are unmanaged and may not be invested in directly. Have a nice day. Okay.